The US dollar is at its highest level in 20 years against all the major currencies. And according to a research from Morgan Stanley, every time dollar hit a peak, it coincided with a horrible economic event like a bubble or a crash or something of that kind. It doesn't matter if you are living in the US or in any other country in the world. Dollar is the world's reserve currency, and its price change will have big implications on your day-to-day life. So in this video, we'll try to understand the reason why the dollar is rising and how it affects us and our investments. I know, it's not one of the topics that can make you excited like a new episode of Game of Thrones. But trust me, this is important. Your job, your savings, your investments, everything depends on how the dollar performs. So if you can somehow sit through this, then you will learn a lot and you can carry this information with you for the rest of your life. So let's get started. If you are new here, my name is Srijit, and in this channel, we talk everything about money and personal finance. There are a couple of reasons why the dollar is surging right now, but the main one is something which we all are aware of and we face daily.
And the soaring inflation.
Inflation to be extraordinarily elevated.
The highest rate in 40 years.
Prices continued to rise in September.
Inflation is simply the rise in prices of goods and services. If the price of a loaf of bread changed from $1 to $2 this year, then it's probably because of inflation. But you know what? Inflation as such is not a bad thing. In fact, a small amount of inflation is actually good for the economy. Inflation makes consumers expect prices to continue rising. So people would want to buy now rather than pay more later. For example, if you know that a property will cost the same now and even after 5 years, then you may be less inclined to buy it right now. So inflation at a moderate level drives economic activity. The central banks around the world know this and they aim to keep the inflation at around 2%. But the problem occurs when the rate rises or dips from this level. But what does inflation has to do with the value of the dollar? That's the doing of the US Federal Reserve or the US Central Bank. Now we know that the Feds or the US Central Bank wants to keep the inflation at around 2%. So to reduce the inflation or to reduce the prices, they have to either increase the supply or reduce the demand. The supply side is out of their reach. They can't do anything to increase the oil supply or manufacturing. But what they can control is the demand part. They can reduce the demand by decreasing the amount of money in the economy. When people have less money, they spend less, thereby reducing the demand and the price. But how can the Federal Reserve pull out the money from the economy? Increasing the money supply is easy. The Feds can just print more currency notes. But they can't ask everyone to burn their notes, right? So the central bank uses certain methods called the monetary policy and then pulls a control lever called the federal fund rate. The federal funds rate is a rate the banks charge each other for lending their excess reserve or cash. Yes, you heard it right. The banks lend money to each other. I will explain. Now, we all know how the bank makes money. They take deposits and lend them to earn an interest. But they can't lend all the money up to the last coin. They will always need some minimum funds on hand to settle transactions and satisfy the Federal Reserve. They are required by law to hold a certain percentage of the deposits as a backup. So it could be that some banks may have excess cash at the end of a banking day while others might be running short. So those banks can borrow money from other banks at the rates set by the central bank. This rate is a federal fund rate. So when the Fed increases the fund rate, it costs more for the banks to borrow. They will now transfer the burden to the general public by increasing interest rates on mortgages, business loans, etc. That means fewer people and businesses take out loans, job growth slows, and spending and demand decreases. This will lead to a fall in prices of goods and services and keep inflation in check. But when something is short in supply, its value obviously increases. Fewer dollars on the street means each dollar will be valued more. The federal fund rate has a far more sweeping impact on the economy. It also affects what's called the treasury bond interest rates or the bond yields. A bond is a debt security issued by a government to raise money, and they are kind of like the safest investments. The bond interest rates and yields increases when the federal fund rate increases, and the US treasury bonds can be bought only in dollars. So investors worldwide would want to exchange the weaker performing assets like stocks, real estates, or the weaker currencies instead for the dollar. Investors also tend to buy dollars when the global economy is under pressure because dollar has a unique status of the world's reserve currency. So that also lifts the prices up. Now, inflation is not something specific to the US. Every country is suffering from inflation and most central banks have raised their rates to control inflation. Then why only the dollar is getting stronger? Why wouldn't investors want to keep the money at home and invest in their own assets and currencies? Let's say China, for example, the world's second largest economy. The real estate market in China represents 30% of the GDP and is currently under fire. And a zero COVID policy means that the economy can't recover and return to pre-pandemic times anytime soon. Japan is struggling with a lower global demand for its manufactured goods, which make up a better part of their exports. Now, when we come to Europe, the countries there aren't doing any better. They are bearing the brunt of Russia's war on Ukraine with significantly high energy costs. And in UK, the government recently released a huge package of tax cuts without a solid plan, thereby cutting the investor confidence. And that brings everyone right back to the US dollar, pushing the prices high. Now, what does a stronger dollar mean for consumers and investors? Let's look into that. First, we will talk about American consumers because they benefit most from this trend. A strong dollar makes imported goods cheaper for US consumers. For example, the German cars are very popular in US. For a car that costs 30,000 euros with an rate of €1 to $1.2, you had to pay $36,000 or equivalent. But now with the current exchange rate of €1 to $1, you only have to pay $30,000. It would also get cheaper for Americans to travel abroad because the same amount of dollars would go much further than what they did some years ago. Most people, when they see that the currency is getting stronger, they believe that it's a good thing, but it's not all rainbows and sunshine. There are also some negative aspects to it that we should talk about. When your country has a stronger currency, then your exports become much more expensive. Suppose you are a company in US selling stuff in another country in their own currency. When you convert it back to dollars, you will get fewer dollars for all the stuff that you sold, and that means you made less money now. China, for example, intentionally keeps its currency weak because this allows them to boost their exports and help its manufacturing business. Approximately 40% of the earnings of all the companies in the S&P 500 comes from outside the US, and when the dollar gets stronger, that means all these companies will make less money. And when they make less money, they will cut down the jobs, leading to a recession. But those who will be most hurt by a stronger dollar are the emerging economies. Most of the world's commodities are priced and sold in dollars. So these countries now have to pay more to import essential commodities. For example, Sri Lanka's economy is starting to crumble as it deals with a shortage of dollars to pay for imports of essential items such as oil. Now, when it comes to the stock market, this chart shows what happens to earnings when the dollar prices go up and down. If the dollar becomes stronger, the earnings tend to remain low. This is mainly due to the factors such as bonds becoming more attractive than stocks and companies making less money from exports. We should expect the dollar to remain stronger until the Federal Reserve reverses its monetary policy and starts reducing the interest rates. And that depends on how well we can control inflation in the coming months. Many people think the inflation has peaked already and the Feds are done with the rate hikes, but we can't say that for sure. But there is a general consensus that a global recession is likely sometime in 2023. You can watch this video to know how to survive and build wealth during a recession. Thank you so much for watching up to this point, and if you think you got some value from this video, give it a like and think of subscribing to the channel. Until I see you with another video, take care, stay happy, and bye.